afternoon, everyone, and welcome back. It's Wednesday at 12:15. We are here for another live show of the Orlando Homeowners Show, and I'm excited because there's a guy named Jeff Stackman from the Asset Exchange Company talking to us about 1031 exchanges. If you don't know what it is, yet you'd like to be an investor, you need to know what it is. So stay tuned. We'll be right back. Jeff, how are you, sir?
Hey, I'm doing good, Rick. Thanks for inviting me today.
Thank you for joining us. Okay, we've already got our first hello on Facebook from Rio de Janeiro. So we're international right now, Jeff. That's pretty international viewer, and thanks for jumping on here, Jason. Today, if you're listening to this or watching this, we're talking with Jeff as he's going to talk to us and how he can guide us and be a resource for us for 1031 exchanges. And as you know, this is the investor series. We're talking specifically to real estate investors. So Jeff, pretend you're talking to somebody who has no clue what a 1031 exchange is. I guess before we do that, give us a little bit of your quick bio of who you are and the company you're with. That way we know who we're talking to, and if we want to get in contact, how we can stay in touch with you.
So again, it's Asset Exchange Company. We're what's known as a qualified intermediary, QI for short. And we're going to dive in just in a few minutes and more details of exactly what we do. But basically, we help facilitate 1031 exchanges. We're a national company, been in business since 2006. Done about 35,000 1031 exchanges over that time period.
That's it.
Myself, I've been in the business for 26 years. I'm originally from New Orleans, so if y'all hear the accent come through, please forgive me. Every now and then it rears its ugly head. But I've actually lived in the Tampa area of Florida for 23 out of those 26 years. So I've done just about everything there is to do in the title and real estate industry.
Well, and can you be a QI, qualified intermediary? Can you do that for anybody nationwide, or is it specific to your state you're in?
Nationwide. The 1031 exchange statute is a federal code, so it doesn't change from state to state. So it's universal throughout the United States. It doesn't matter if it's Florida property, California, New York, Chicago. None of that changes from state to state.
Gotcha. So 1031 is a national coding, not a state coding. So thank you for jumping on here. You and we got introduced via a third party on a Facebook post out there. I said, I've got a 1031 exchange question. Who's the expert? You and I connected, and 25 minutes later after a conversation, I said, we need to recreate that conversation, put it on a show. And so thanks for jumping on. So as we're talking to consumers out there, what exactly does 1031 exchange do for them? Why is it important knowledge for them, and how will it save them money?
Yeah, so typically, if you own a piece of investment property or even property that you use in your trade or business, any type of real property in your trade or business or that you hold for investment, when you go to sell that property, if you have any gain in the property, well, you're going to be subject to capital gains taxes. Now, capital gains taxes right now or either 15 or 20%. It just depends on your individual tax filing status. So they're going to hit you with the 15 to 20% capital gains tax. And then on top of that, they also are going to hit you with another tax. It's referred to as depreciation recapture tax. And that's an additional 25% tax. Now, I know everybody's saying, well, hey, how does that work? Well, the depreciation recapture tax works like this. Any depreciation that you've claimed in that property or the lifetime that you've owned it, when you go to sell that property, they're going to hit you with a 25% tax just on the depreciation alone. All right. And it even gets better, folks. On top of that, you may also be subject to what they refer to as the Medicare tax. Well, that's an additional 3.8% tax. All right. You may or may not be subject to that. So when you do a 1031 exchange, you can defer having to pay any of those taxes. Now, Rick and I, we're located here in Florida. We don't have state income taxes, so we don't need to worry about that. But if you live in a state, or even if you're selling property in a state, you would also be subject to state income taxes. Well, the beauty of 1031 exchange, you can also avoid having to pay those state income taxes when you do a 1031. Now, every state kind of has their own way of you filling out some type of form or going through some type of process in order to get out of those state taxes. So that's the benefit of doing a 1031 exchange.
I want to break that down. There's a lot of numbers, a lot of taxes, and as an investor or even as an owner, if I inherit money, I'm going, that's a lot of my margins that just went down the drain. So, we've talked to some flippers in the last couple of weeks, and let's say I buy a house, Jeff, for 100,000, and I put 30,000 into it, and I sell it for 170. So with that, I've profited $40,000. You following me?
Following. Mm-hmm.
Now, if I don't do this through a 1031 exchange and I sell it, first I want to ask, is there a time frame? I've heard from a lot of people that if you hold onto it for at least a year and a day, there's less tax implications than less than a year. Can you verify that or not?
Yeah, so what you're referring to is if you own a property for less than a year, an investment property, if you sell it prior to owning it for a year, you're going to be subject to what they refer to as short-term capital gain. So, and that's based off of your individual tax filing status. I just mentioned to you guys, capital gains tax is either 15 or 20%. Well, your individual tax filing status could actually be higher, your income tax rates. Now, once you own it for longer than a year, you get into what's referred to as long-term capital gains, and that's what I was talking about, the 15 or 20%.
So short-term, more than 15 to 20%?
Absolutely, yeah. It's going to be based off of your income tax rate, whatever that may be.
Okay, so it just goes to your tax filings as added income that you owe taxes on it, whatever tax bracket you're paying on. Got it. Okay. However, if I buy it, it's a rental, and then 3 years later I choose to sell it. Now that's long term. Is it 15 to 20% on top of my income, or is it no longer part of it?
No, it's a separate tax. So they base it off of whatever your gain is.
Okay.
And we don't have a lot of time to go into it today, but that's what your taxes are based off of.
Okay.
The gain, and then also the depreciation, whatever you claim.
So if we go through that scenario of a 90-day flip, I buy for 100, I put 30 in it, I sell it for 170, I have $40,000. There's a short-term taxes, whatever my income is, $40,000. If I'm 20%, and I'm going to owe them another $8,000. I'm also going to owe them depreciation recapture, but I'm not really depreciating anything in that flip. Would you agree with that?
Right. Yeah. If you've only owned it for 90 days, and I'll stop you right there, because if you only owned it for 90 days, okay, historically or typically a person that we refer to as a flipper, they buy a property, all right, 3 months goes by, they fix it up, and then they turn around and sell it. Those types of property are actually not able to do 1031 exchanges. Perfect. They're excluded from 1031 exchanges because with 1031 exchange, you must own property that you use in your trade or business or you hold for investment. They consider somebody that's a flipper is what they say, they refer to them as a dealer. And a dealer is somebody that fixes up properties and they turn around and sell it. That's like their inventory. That's the business that they're in. They're holding properties for sale and they're not holding them for investment. So in order to qualify for 1031 exchange, you have to be able to prove that you held the property for investment and not for sale. All right, so what I would recommend for flippers is you could possibly do this. Let's say 3 months goes by, or however long it takes you to to fix it up. And at the end, they go to you, Rick, and they say, hey, Rick, can you list this property in the MLS and let's show it for rent, and make sure you put it in there for fair market value. That's a little different, right? Because now what's happening? They're showing their intent that they're holding it for investment and they're not holding it for sale. All right. Hey, who knows? Maybe they show it to a potential renter, right? They run a credit report, a credit check on that potential renter, and what happens? Hey, they have horrible credit, and they don't even rent it to that potential renter, right? All of that type of stuff is going to be their backup. Trail of breadcrumbs, right, to prove that they held that property for investment and not for sale, all right? So that's what I recommend, because they could prove it. If the IRS comes in and says, hey, prove that you held it for investment and not for sale, they could say, look, here's the day I sent an email to Rick asking him to put in MLS for fair market value. Here's the MLS listing showing it fair market value. Here's the day I showed it to that potential renter. Again, if they ever get audited, they're going to have to be able to back it. So if I'm hearing you correctly,
if I buy a house, I rehab it, and I've got it now, and I've got a choice to sell it or to hold it. Maybe I can do both, whichever is the better opportunity that comes to me. And so I'm going to list it for rent and list it for sale. Once I get a contract of either one, then obviously I've got to push pause on the other one, right? So if I get a contract for sale, it's no longer for rent, or vice versa. By doing so, I do have intent, or at least I'm open to renting it out as a long-term investment. And then therefore, now with that, if I do indeed sell it as a flip and I make that $40,000 profit, I wouldn't really use it. I would just take that profit, call it income, pay taxes, and do it again, or buy the next hold.
Right, you could do that. Yeah, you wouldn't even do a 1031.
But if we need to be prepared for that plan B, we've got to do it. Now, let's go into the holding conversation, because there's a lot of rules and regulations around this. And Jeff, I've had something with one of our investors come up since then, but I talked with you initially of going, what are the timelines? So now I own a home. I'm a long-term investor. I'll give you our house, for example. My wife bought it when she was living by herself for $120,000. That was in 2010. It's now worth about $275,000. We've also had depreciated value. If we were to sell it, then that difference of 120 to 275 is 155. That's what I would be subject to pay capital gains on. Is that correct?
Roughly, yeah. That's not exactly how you calculate it, but for today we'll use those numbers.
For today, for those terms. So now I've got a choice. Take that 155, take my licks, pay my taxes, pay my depreciation recapture, Medicare tax, and then whatever I choose to do with that money, vacation, put in a swimming pool, buy crypto coin, whatever. It's just done. Right. Or through a 1031, I take that $155,000, give or take, I give it to your company, and you hold on to it through that qualifying intermediary stage.
Yeah, and it's not even so the 155. It's not based off of what you purchased it for and what you sell it for. It's actually whatever the proceeds are from the sale, right? Okay. That's what you need to use towards buying your replacement property. So the rules for 1031 exchange: to defer your taxes 100%. All right, you have to take the proceeds from the sale, and basically the way they figure out the proceeds, they'd say, what's your sales price? Do you have any debt that you're paying off, like a loan, whatever that amount is? And then you also deduct out closing costs, certain types of closing costs like real estate commissions, title insurance, closing fees, some of those non-reoccurring type of fees, you deduct those out, and then that's going to give you the net proceeds. It's basically the cash. Like if you didn't do a 1031 exchange, how much would you walk away from that closing table? All right.
Perfect.
So to defer your taxes 100%, the rules say you can never have receipt of those proceeds. That's where we come in. All right. Again, we're what's known as a qualified intermediary. Now, other people you may hear other terms people refer to as an accommodator. Another common term is a facilitator, or maybe just simply an intermediary. But in our neck of the woods, people just call us QIs. All right.
Okay.
We hold those proceeds on behalf of the seller, the exchanger. Right? They have to use that entire amount, right? And they have to go out and they have to buy a replacement property, or it can even be a combination of properties where the purchase price or the combined purchase prices are either equal to or greater than whatever the sales price was on the property that was sold. We refer to that property as the relinquished property. All right. Okay. That's rule number 1. Okay. Rule number 2 is if you have debt, a loan that you're paying off, okay, you're required to obtain an equal amount or greater debt in any replacement property or properties. Now, that rule can actually have an exception, all right? If you have cash that you can add to the purchase of your replacement property, you can offset any type of debt that you're required to obtain, okay? That's the rules, okay. All right? Now, do you want me to talk about the timelines?
Yeah, let's go for it.
All right, so for when you sell your relinquished property, all right, you'll have 180 calendar days to purchase any replacement property or properties, all right? And that's calendar days. Now, Rick and I, we live here in Florida, right? Well, from June 1st to November 30th, what's going on in Florida and anywhere throughout the eastern United States or the Gulf Coast? Hurricane season, right? Well, look, if we're getting hit with a hurricane and everything's shutting down for a day or two, whatever it may be, it does not matter, all right? That clock is still going to be ticking, all right? So you have a total of 180 days to purchase whatever replacement property or properties that you want, all right?
When we say purchase, you're talking about closed, you own access, you own the title.
Over and done with. Yep. Closed and final Final purchase, titles transfer. Okay.
Perfect.
Now, the first 45 days of the 180, all right, they refer to that as the identification period. All right. And what that means is you must identify any potential property or properties that you want to purchase. Now, they don't have to be under contract, right? You just have to identify them. Now, that's something else that we're going to help with, right? We're going to provide a form to the client, the exchanger, right? And on that form, there's going to be some blank lines. It's going to have to be specific to a property address or addresses, right? So they'll have to fill it out, get it back to us by midnight of the 45th day. That's how they will formally identify their replacement property. After midnight of the 45th day, there is no exceptions to that list, okay? You must be able to purchase one of those properties that you identified by midnight of the 45th day, all right? If you're unable to purchase any of those properties, you're going to be paying all your taxes, all right? If you are not closing on that property by day 180, let's say you're closing on it on day 181, you're going to be paying all your taxes. All right. So it's very specific to 45 days to identify, a total of 180 to purchase your replacement property.
So let's do some hypotheticals out there, Jeff. I sell my property. I give it to you with my proceeds. You're holding on to those net proceeds in a 1031 exchange. I now have 45 days to send you my next purchase property. If I sold for 275, my next one needs to at least be purchased for 275. Or I could buy two homes, one for 125, one for 150. Is that accurate as well?
That's right.
As long as the total is at least 275. If I owe $75,000 on it, I need to also owe at least $75,000 on this one. So I can't just go out and pay cash.
Or if you say, well, I don't want to get a loan for $75,000. If you happen to have $75,000 cash, and you say, okay, I'm willing to part ways with that to purchase the replacement property, that would work for you.
Okay.
Right? Or you can even do this. You could say, well, I don't have $75,000 cash. I do have some cash I'm willing to part with. You can use that towards purchasing the replacement property, and then the difference you can make up in a loan.
Okay, perfect. Okay. So the loan thing actually isn't too important. It is that purchase price, that timeline. If I give you property 123 Main Street, and this is the one I want, and we are all good, and all of a sudden the seller gets a change of heart or something, I get a change of heart, and it's beyond 45 days, but that house I identified is no longer available, and I haven't identified another one, game's over, right?
That's it, game's over, right.
You send the money back to me, and I pay the normal taxes through it.
That's right, as if it didn't even occur.
In this competitive market, if it's day 30, day 40, day 44, and I'm not sure which one, can I send you 5 properties hoping one of them will stick? Is that allowed?
Oh, you could, yeah. But there's various rules as far as identification goes. If you identify 3 properties or less, the purchase prices can be any dollar amount. It's referred to as the 3 property rule. Right? Okay. Now, in your example, if you actually identify more than 3 properties, you said, well, if I identify 5 properties, no problem. But you fall into this other rule. It's referred to as the 200% rule. And what that states is you cannot exceed 200% or 2 times whatever the sales price was on the property that you sold. All right. So let's just say you sell for $200,000. Okay. If you identify 5 properties, okay, then the combined purchase prices of all 5 of those properties could not exceed $400,000. Because where am I getting the 400? 200. You sold for 200,000. 200% of the 200,000 sales price, or 2 times that 200,000 sales price, is how much? 400,000.
Okay, so that gives me a little bit of wiggle room, but not that I can send you the farm.
Yeah,
knowing one's a mistake.
The IRS doesn't want to give you the ability to just identify everything under the sun. Okay, they want to limit you in what you can identify. They want you to be serious of what you potentially want to buy.
Perfect. So get serious by day 45, or you might lose it. And from that, I don't have to be under contract by day 45. I just need to send it to you. However, I need to close within 180 days from when I sold my first one. Now, what is the cost? Because we're looking at this, and now as an investor, I'm thinking there's going to be a holding cost for you, Jeff. What's it going to cost someone to send their money to you to hold in 1031?
Yeah, so our fee is really simple. All right, we charge $750 on the sale okay? We don't actually collect anything until it physically closes. Because the way it works is we really start doing our thing once a contract gets signed and the property being sold. Because the way the process works is I need to get a copy of the contract, and then I also need to find out who's going to be handling the closing. Maybe it's a title company, escrow company, attorney. What happens is we reach out to that company and we get what's referred to from them, a copy of the title search. It's also referred to as a title commitment or a title binder, okay? Once we get those documents in hand, we turn around and prepare what's referred to as an exchange agreement, all right? And those are going to be documents that are going to set their exchange up. We're going to send those over to whoever's going to be handling the closing. Day of closing, when the client comes in, the seller comes in, they're going to sign those documents. That's when we collect that $750. Now, if for some reason it never gets to closing, the contract falls apart, we don't charge any kind of cancellation fees. We don't charge any type of wiring fees, anything like that, all right? We charge $750 on the sale. And then when they purchase their replacement property, we charge $250, okay? So if you sell one property, you buy one property, our total fee is $1,000. That's it. There's no other hidden. If you never get to the closing, if you never purchase a replacement property, the only thing you would be out of, at least from us, is $750 because we would have collected. Now, here's a point I want to make too. Sometimes people call me and they say, well, Jeff, I'd love to do a 1031 exchange because I'm looking at a huge gain, right? But like Rick said, it's a really tight market right now. I just don't know if I'm going to be able to find that perfect replacement property, right? 45 days isn't that long of a period of time, right? And I'll tell them this. I say, well, if you close and then you call me, it's going to be too late, right? Because once you receive those funds from the closing, that's it. You've lost your ability to do a 1031 exchange. So I tell people this. I say, look, we can set it up for you. On the day of closing, we're going to charge you $750, but at least it's going to buy you another 45 days to try to get it all figured out, all right?
Right.
And if after 45 days you don't find that perfect property, on day 46 you're paying all your taxes. The only thing you would be out of, at least from us, would be $750. So in the whole scheme of things, some people might be looking at, gosh, I'm looking at a $20,000 tax bill if I don't do a 1031 exchange. Well, is it worth their while to pay $750 and give themselves another 45 days? Because hey, if they do find that perfect property, they can complete their exchange. They defer all those taxes, but you know what? If they don't, the only thing they're out of is $750. Right?
So this bears repeating, and I know we're going to watch the time. We have about 5 or 6 minutes left. If I intend to do a 1031 exchange, I need to tell you when I get to contract, not after I close, because as soon as that money from title, those proceeds go into my personal account, it's done. I can't then activate it with you. How much time frame do you need? Is it 48 hours? Is it 2 weeks? What are you looking at here?
We can do it the day of closing, right? That's going to be our little secret today. Yeah, we prefer not to. I have some of these brochures. I'll show you guys. I have some of these brochures, okay? They sit in title companies, attorneys' offices, real estate offices. I kid you not. Sometimes people are sitting in the lobby waiting to do their closing, and they're looking at this brochure, and they say, wow, 1031 exchange? Hey, Mr. and Mrs. Closer, I want to do a 1031 exchange. And they go grab their closer, and they pick up the phone, and they say, hey, Jeff, guess what? I have a 1031 exchange for you. It's closing in 5 minutes. Can you do it? Now, they may have to go down to Starbucks and get a cup of coffee, but yeah, we can do it that fast, right? But if they walk out the door, it's too late, okay?
And just to be clear, I think we iterated this, but this is not for primary residence because you're not paying any capital gains primary residence. So this is just if you are a non-owner occupied investor, whether it's Airbnb, VRBO, long-term, short-term, whatever sort of rental, if it is not homestead and you are receiving some sort of rental income or intent to have rental income,
that's right,
then you're there.
And the other thing too is, as I mentioned, it could also be property that you use in your trade or business. Okay. Maybe
perfect. So you work out of it, or storefront, or commercial, that sort of thing. So
right, like the office, you're with Keller Williams, right?
Yep.
Where your office is located, right? If y'all own the building, right, you could sell that building in a 1031 exchange, and go down the street or wherever you may want, buy another building, and you move your office in there.
Move right there. Perfect. Now, we know the 3 property rule, the new 200-day rule. I had a thought there, and I want to make sure I didn't lose it. But while we're doing that, you are teaching a class, and you're teaching it with us on March 9th from 1 to 3 o'clock. Let me pull it up real quick, share the screen. And if you're listening to this via podcast, I'm going to make sure that you've got a link here below. But let's see here, and do you have the screen? So we see it now? I'm going to zoom in a little bit. Tell me what we're looking at here, Jeff. This is an awful rendition of what we've got.
I actually offer three different classes. The one that we're teaching with Rick is the one that's referred to. It's on the Discovering 1031 Exchanges. Now that one, it's a 2-hour class. It's from 1 to 3 Eastern time. All right. I'm going to cover everything from beginning to end in that class. And the added benefit with that class is, if you happen to have your Florida real estate license, it's worth 2 continuing ed hours. All right, anybody can attend it, but again, if you're a Florida realtor, you will have the benefit of getting 2 continuing ed hours with it. I think Rick has a link. You just need to register for it. And
yep, I'm putting the link here right now. And again, if you're listening to this via podcast, that link is going to be there. But I went ahead and put the link both in the Facebook and the YouTube. So right there, it's a go-to webinar. Is there a cost for this, Jeff?
No, there's no cost. It's totally free. We just touched upon some of the basic topics today, but we're going to talk about how to calculate what the taxes are. We're going to talk about some of the advantages of estate planning. We're going to talk about entities, what rules apply to entities, foreign sellers, buying and selling property from related parties, all sorts of different things. So
all sorts of scenarios.
Please join in.
Well, this is so important because, as a realtor, as an advocate, when people trust me to help them with their financial wealth through real estate, if I don't know the ins and outs of this, am I really truly being an advocate for them? Jeff, a couple quick scenarios for you, and I'll have you comment on it. I had an investor. He purchased it via an LLC. He had it 1031 exchange. We actually had a floating closing date that he wanted to use so he could identify it, yet he learned that you cannot do a 1031 with an LLC, something along those lines. Can you elaborate on that a little bit for me?
No, actually you can. You can do a 1031. Any type of legal entity that owns real property can do a 1031 exchange. Individuals can do 1031 exchanges, trust, husband and wife, spouses. The thing that we see with LLCs, for entities in general, they can either be what's referred to as a regarded entity or a disregarded entity. Now, a disregarded entity, it's common like for LLCs, maybe you have a single member LLC, and for that particular LLC, you don't file a separate tax return for that LLC. Anything to do with that LLC, you just put in your personal taxes.
Sure.
Well, that's referred to as a disregarded entity. So with 1031 exchange, it's important whoever the taxpayer is in the sale of the relinquished property needs to be that same taxpayer in the purchase of any replacement property or properties. So if you sell a property as an individual or you sell it as in your disregarded LLC, you can purchase the replacement property in the name of you as an individual, or you can even purchase it in the name of your disregarded LLC, because for tax purposes, they're one and the same. Right?
Okay.
Your client, what they may have run into, if you have an LLC that has partners and it files a separate tax return, that's referred to as a regarded entity. All right. So think about it. If all of us on the call today, if we're all involved with a partnership, right, and we own a building, right, and our partnership files a separate tax return, and typically they would issue what's referred to as a K-1, right? Well, we don't own that building as individuals, right? A partnership does. So if we do a 1031 exchange, we could never try to go out and buy replacement property as us as individuals, right? It would have to be in the name of our partnership,
sure,
LLC. Sure. Okay. So again, whoever the taxpayer is in the sale of the relinquished property has to be that same taxpayer in the purchase of the replacement property.
Got it. And we'll learn more about all of those ins and outs on March 9th as well.
We're going to cover that kind of stuff in the class.
Final thought for frequently asked question. If and this is how you and I spoke, if I sell my properties to go buy myself a vacation home that I eventually will go live in, Yet I intend to just make it my vacation home. Does rental property qualify for what you're talking about? And if so, do I need to live in it for a certain period of time versus not to make it primary? Tell me about that.
Yeah, so for vacation homes, there's special rules that apply to vacation homes. All right. And I talk about this all the time because why? Because I'm here in Florida, right?
Sure.
In Florida, everybody has a vacation home or wants a vacation home. So it's actually referred to as Revenue Procedure 2008-16, not to get too technical on you guys, but they say, okay, for that vacation home to be considered an investment property, the rules are you must own it for at least 2 years for 24 months, all right? For every 12-month period of ownership, sorry guys, you must rent the property out for at least 14 days at fair market value. Okay, now you can use it for some personal use, right? For every 12-month period of ownership, you can actually use it for 14 days personal use or 10% of the total time that you had it rented during that 12-month period. So I always give the people an example, like, let's just say during that 12-month period, let's say you rented that property out for 200 days, right? So 10% of 200 would be what?
20 days.
So you could use it for 20 days personal use instead of the 14. If it meets those guidelines, it qualifies as an investment property. Now, what's the flip side? People say, well, what if I wanted to use it a little bit more than that? Or what if I don't rent it out for that long? You know what? In that case, talk to your CPA, all right? Yeah, because your CPA is going to have way more information about your tax situation than I ever would, that I would even ever want to know. If the CPA comes back and says, hey, I think we can make the case that we can, if we ever get audited, that we can justify that property as being an investment property, then hey, by all means, move forward and sell it.
And like you said, the risk is $750 to risk that you can get all the tax deferring there. Final thought, because I think this is super important to know, and we are over on borrowed time. If you have, I told you I could keep going, Jeff. If you inherit assets of property from somebody via estate or will, then that resets that capital gain.
Yeah. So I know we're over time, but the way 1031 exchange works is you're not limited to how many times you can do a 1031 exchange. All right, you can keep deferring over the course of your lifetime. And what happens when you die, if you have the heirs that inherit your property, they're going to get a benefit that's referred to as a step up in basis. And basically what that means is whatever the value is when they inherit it, that's their starting point. All those deferrals that you would have done over the course of your lifetime, basically they go away and no one ever has to pay the taxes. All right.
Because my initial hunch is all we're doing is kicking the can until one day we pay this massive lump sum. And that's true if you cash out. It's not true if it's part of your will and your estate and your legacy. So
right.
Everyone,
yeah, go ahead.
Yeah, I was going to close this off here, but final thoughts. Go ahead, Jeff.
Yeah. So again, we have the class that's coming up on the 9th,
March 9th, 1 o'clock to 3 o'clock.
Yeah, 1 Eastern time. I know we have some other people that might be on different time zones. And we're going to talk about that whole estate planning. A lot of the topics that we just touched upon today, we're gonna cover in that class. It's 2 hours, so I talk about this every day, all day. If anybody has any questions, you want to talk beforehand, my information is scrolling at the bottom. Feel free to shoot me an email, give me a call. Like I said, I talk to people all day long about 1031. If you're a realtor yourself and you have investor clients, hey, don't feel like you have to be an expert. That's what I want to be here for you.
Great stuff. Hey, Jeff, I appreciate it. I'm looking forward to it. I'm going to have a front row seat for you to facilitate that class with you. So please, if you're listening to this before March 9th, 2021, and this was intriguing enough to you, please mark that calendar and join us there. Jeff, I look forward to it. Until then, have a great week. We'll talk to you soon, Jeff.
All right, thank you. Bye. Thanks for